Good day. In the previous video, we took a look how to deal with first in, first out and weighted average costing methods. Now, there's a question. Where we'll use these calculated amounts, why we need them. Imagine that we made inventory count at the end of accounting period. Now we know quantity of our stock items, but in our statements we cannot mention quantity. We need amount which represents total value of our inventory. In valuation of the counted items, we can use NRV or cost model. If we will use cost model, then we can choose one of first in, first out or weighted average costing methods. Calculated amount is debited an inventory account and crediting to the profit or loss account at the end of accounting period. Inventory will therefore have a debit balance at the end of the period, and this balance will be shown in the statement of financial position as a current asset. Inventory account is only ever used at the end of the accounting period for recording value of counted inventory. Let's try and understand with examples. Let's suppose that it is the end of the reporting period. We have following balances in our accounts. Let's take that we made inventory count, and in inventory valuation of the counted items, we use first in, first out method. After calculation of the total value of inventory, we will debit this amount in our inventory account. Credit side of transaction will be in cost of sold goods. Then we will sum all purchases and debit cost of goods sold account in this amount. Balancing figure in this account will be appear in our cost of sold goods. This figure should be debited to the profit or loss statement. To prepare a little profit or loss statement, we need to summarize all sales and credit to the profit and loss statement. After all, we'll have gross profit in 1,760 yen. Take into the account that there shouldn't be any balances in the purchase and sales accounts. At the end of the reporting period, they should be transferred to the profit and loss statement. Let's change valuation method of the counted items to the weighted average costing method. With this method, our inventory value will be different amount. All further transactions will be same. We'll have different cost of goods sold amount, and gross profit will be different due change cost of goods sold amount. If we will compare both calculations, we will see difference between more clear. Cost of goods calculation formula is opening inventory, in other words, total inventory value of previous inventory count plus purchase minus closing inventory. Total inventory value of current inventory count. In this case, we haven't got opening inventory. We can face with the question that based on what business makes choose between these two methods. It depends from the nature of the inventory. For example, if it's food or something with short useful life, it's advised to use first in, first out. Otherwise, you can use weighted average costing method. All these examples were given with good scenario for the business, but there could be some unexpected events like robbery, fire in the store, accident in the internal transfer, or any other damage. In this case, book quantity of goods will be differ from actual quantity. How all this will affect our cost of goods sold amount. Suppose that we have show business. At the beginning of the period, business have 6,000 pair of shoes in stores. During the period, business purchased 5,760 pair of shoes and sold 4,800 shoes. To do calculation, we can say that there should be 6,960 shoes at the end of reporting period. Let's take average and purchase prices is 10 yen. Now we can calculate cost of goods sold was a formula opening inventory plus purchase minus closing inventory. So book value of the inventory should be 48,000. If everything will be okay, book value should be the same with the actual one. But unfortunately, as the 29th of April, 100 pair of shoes was stolen. At the end of the reporting period, opening inventory and purchase amounts will be the same. But when we will make inventory count at the end of the period, we will realize that we have 100 pair less than book quantity. So cost of sale will be much more in amount of stolen shoes. The quantity of the inventory held at the period is established by the physical count of inventory in an annual counting or by continuous inventory. In simple cases, usually when a business holds easily counted and relatively small amounts of inventory, quantity of inventory on hand at the reporting date can be determined by the physically counting them in an inventory account at that date. In more complicated cases, where a business holds considerable quantities of varied inventories, an alternative approach to establishing quantities is to maintain continuous inventory record. This means that a card or computerized record is kept for every item of inventory, showing receipts or issuing from the stores and a running total. A few inventory items are counted each day to make sure their record cards are correct. This is called a continuous count because it's spread out over the period rather than completed in one count at the end of reporting date. Last and little note which expense are included to cost of purchase. Cost of sold goods includes all the costs and expenses directly related to the production of cost. In other words, all expenses which is needed to make ready goods for the sale. Costs include direct costs such as overhead, sale, marketing, storage expenses. Also, carriage inwards is included in the cost of purchases. Carriage outwards is a selling expense. If you found this video useful, it will kind from you to follow and subscribe the channel. Thank you for your attention.